the Fed has really is in the process of transitioning from fighting a battle on two fronts, dealing with both inflation as well as slowing labor growth, to really, I think today's figures were the fourth softer than expected inflation figures in a row. And so it really suggests that the Fed's going to be focusing more than anything on the labor markets going forward. With respect to the size of the cut, one of the things the markets have moved towards over the last month have been, are we going to have a cut in September, to, okay, we're definitely having a cut in September, to, okay, well, maybe we'll have, two quarter point cuts in September. And I think two cuts is probably a bit aggressive. That said, I think that the place that investors should really be focused on is not necessarily what happens in September, but where those rates ultimately settle out at. And, we expect over the next 12 to 18 months to hit a neutral rate would probably suggest 7 to 8 quarter point cuts, which, frankly, would probably leave the Fed fund rate, 3 to 3.5%, a bit higher than markets might have actually been accustomed to dealing with over the last 20 to 25 years. And so investors should brace for declining rates in the near term, but over the longer term, maybe being a little bit higher for longer.
Burns, it's Sam here. Very good morning, good evening your time. I wanted to ask you about something that you pointed out in your notes, and it was something that I heard our colleague Morgan Brennan also talking to Claudia Sahm about overnight, and that is the shelter part of the equation. It seems to be a bit of a sticky component here. I mean, how worrying is this in this sort of disinflationary narrative that the Fed is so reliant on?
It's something that investors, it kind of, when you look at the CPI print, it's kind of beneath the surface. It's one of the interesting things about the CPI today was the fact that it came in below expectations, despite the fact that the housing figures were above expectations, the shelter cost, that is. And really, we're looking at a core CPI of roughly 3%. And most of what's driving that above the Fed's 2% target is shelter costs. And what's fascinating about that is that the shelter cost figure is a stable number. A lot of times people don't update their rents immediately. And if you look at real-time data, it suggests that that's already in the process of rolling over. So if anything, one contrarian take would be that if we look out 6 to 12 months, not only should the Fed end up seeing inflation come back down to that 2% target, but they may end up overshooting that. We might be starting to talk about the words deflation over the next 12 months.